Hello and welcome back to another episode of the For the Property Investor podcast. And we're here with the weekly news. And of course, the only man that brings us the weekly news is Nick Bendel. Welcome again, Nick.
Well, thank you for having me, Owen. I always love chatting to you on a Monday morning.
Yes, it's and it's a lovely Monday morning as well. So the sun is shining. It's a nice winter's morning.
Except I think listeners might be confused, listeners and viewers, because we record on a Monday morning, but we don't publish on a Monday morning.
No, it's at earliest it's Monday afternoon. It would come out. So depends on where you're listening and getting the updates. So of course, maybe we should just plug this, by the way, of informing people. I will reframe that, of letting people know they can get access to the podcast on all of their favorite podcast platforms, including Spotify and Apple Podcasts, as well as YouTube, as well as and across all social media platforms. So yes, wherever you like to hear it, see it, we are available.
Well, that's wonderful. And what have you been up to in the past week, Owen?
Past week has been busy with some leasing right across the country, but we're still quite busy in the growth area for investors in the Central Coast Hunter region, north of Sydney. And we're still looking with Perth being growing along quite steadily. And we are also changing a few of the staff members. So busy with some staffing changes and reallocating of staff responsibilities. So just trying to grow a leaner machine that works a lot better for everyone involved.
And your business, Leifield, does property management in 5 states. And so
That's correct.
when you've got such a large footprint, I guess there are always going to be things at head office that you need to change and upgrade and improve and refine.
Yes, and on the ground as well. So all across the country and all regions we operate in. So processes are very important. Having good back office support staff for the portfolio managers to be able to look after clients, tenants, trades, and everything that happens on the ground with our property managers there.
Wonderful, but you don't. I know you've got a presence in South Australia, but you're not yet active in Cooper Pedy, are you?
Cooper Pedy, no. So just Adelaide Metro at this stage. Cooper Pedy, it's why you think you're buying a little miner's shack, are you, Nick? Or
Probably not. If I was going to buy something in Cooper Pedy, I'd want it to be underground. It does get a little toasty there, even
yes,
even during the cooler months of the year. It's very hot.
yes.
But not looking to buy anything there just yet.
Okay, all right. It'd certainly be interesting managing properties that are underground in an area like that. So yeah, it's I'll have to find someone who operates in that area, and maybe we could get them on as a guest on the podcast to let us know how it all works.
That would be interesting.
Yes. All right, and how's your week been?
I had a really good week. I'm based in Sydney. I went to the MFAA Mortgage Broking Conference in Melbourne during the week. Really, really enjoyed it. I love going to these conferences because I get to meet brokers who I'm friends with, who are clients, who don't yet know that they're going to be clients. They're my favorite ones. I get to chat. I get to press flesh. I get to meet people. So it was enjoyable and productive.
do you tell them when you meet them? It's like, oh, do you know that you're not my client yet, but you will be?
I've never used that exact line. I'm wondering if I should. I just kind of look at them thinking, if only you knew what I knew.
So you don't use those Jedi mind tricks on them.
No, but maybe I should. Maybe I should just be that brazen and say by the end of tonight, baby, you will be a client.
Yes. Let me know how that goes for you, Nick. And talking about that, what's in the news this week? And I believe you have a story about the MFAA.
Indeed, the first story was announced at the conference. The headline is Mortgage Broking Association Makes History. The MFAA has unveiled the first university-level mortgage broker qualification to be offered in Australia, known as the Mortgage Finance Professional Australia designation. Developed in conjunction with RMIT Online, this qualification will be offered exclusively to MFAA brokers who have practiced as a broker for at least 5 years and settled at least 250 loans. To receive the Mortgage Finance Professional Australia designation, brokers must not only complete 40 hours of online learning, but also demonstrate a commitment to professional standards in ethics, education, conduct, and customer engagement. The MFAA said brokers who received the designation could build greater trust with their clients, be recognised as a leader in the sector, and gain a competitive edge by having university-level credentials. Owen, I'm keen to get your thoughts as always. What do you think of the MFAA's new university-level accreditation?
I think it's brilliant. It adds more professionalism to the industry, and it's really looking to add an extra level to recognise those brokers who have got the experience both in time and in actually writing and settling loans, really will help to um, weed out the pretenders from the real experienced brokers. And it's certainly a big difference to when I started in the industry as a mortgage broker, which I'm no longer a mortgage broker, but I was a broker for 12 years. But when I first started, which was over 2 decades ago now, so making me feel a bit old. But yes, back then it was just the mirror test. So if you don't know what the mirror test is, it's like you just had to stand up close to a mirror, and if you fogged it up, then yeah, you got the ticket.
And you passed with flying colours, I heard.
Yeah, I did. I had to take a big deep breath, but yes, it did work. Yeah. So phew. Yeah.
Well, to earn this new qualification, brokers, as we heard, will need to have practiced for at least 5 years and settled at least 250 loans and then done 40 hours of online learning. Has the bar been set too low, too high, or in the right place?
No, well, if you look at that, I mean, 5 years is a good amount of time. If you make it 5 years in the industry, then yeah, you obviously know what you're doing. And 250 loans, I mean, that's settling, effectively one a week for 5 years. And yes, that's very much higher than the average, what the average broker does.
And I'm just wondering, will consumers care about this? In other words, do you think they're going to favour brokers who do have the qualification over brokers who don't?
Um, oh, at the end of the day, there'll be people who don't care, and the average person who's buying a a property, and it might be their first property, or they're not intending on getting another loan for 10 plus years. They'll just go to a broker and say, all right, what's the best deal? And and they might shop around and do what they do to be able to choose a broker. But for clients who have large amounts of lending, and they might own multiple properties, and they need that ongoing good advice to be able to consistently every couple of years rejig their structure and they're lending, they will want to gravitate towards someone that is recognised as formally as a good broker from the industry's point of view.
Well, let me play devil's advocate here. So my business, Hunter and Scribe, it's a copywriting agency. We write content for brokers throughout Australia. And when I'm speaking to a potential new client, I've never had any broker ask me whether I went to uni. I did go to uni. I did study journalism, but I've never had any broker ask me about those qualifications. So I'm wondering then, are consumers going to ask brokers about this new qualification?
Oh yes, many won't. But yeah, you might have it on your LinkedIn profile. You might have it on the bottom of your email signature. You might have it on your letterhead, and all those types of things, which just helps to it's for the same reason if someone's been published in a magazine or if they've been on a television program, as seen on. And it's just a matter of them adding that, and it's just an extra, what do they call it? An extra feather in the bow.
Did you know, I don't know if I've ever told you this, back in 2018, I did a Cert 4 in mortgage broking.
No, I don't think I did.
I keep a lot of secrets from you.
Yeah, you do. They're very secretive, Nick. But was your intention to use it, or was it more for educational purposes?
It was purely for educational purposes.
Did you learn anything?
I did, all of which I've now forgotten, but it did confirm, well, which I already knew, that being a broker is tricky. There's it's not just as maybe some people think, type into a computer and it'll spit out the loan with the lowest rate, and that's what you tell the client. There's far more to it than that. And as part of the training, we had to write a dummy loan application and structure the loan, and that was quite challenging.
Okay, all right. Well, I assume you passed, so well done, congratulations. And it's unfortunately it's not valid anymore. You need to have done your diploma since, and now you can get a university degree.
Yes, I'm only 250 loans and 5 years away from getting it.
Yes, so very good.
Well, our next story, Owen, is RBA aims to strike balance between inflation and unemployment. The Reserve Bank believes it has done a good job with monetary policy over the past 3 years, judging by a speech from Governor Michelle Bullock. She said in her speech, "If you cast your mind back to 2022, you will recall that inflation was higher than it had been in decades, peaking at 7.8% at the end of that year. It was this rise in inflation that required a tightening in monetary policy over 2022 and 2023, with the cash rate increasing from almost 0 to 4.35% over that period. Over the past couple of years, we have made meaningful progress in bringing inflation down. Higher interest rates have been working to bring aggregate demand and supply closer towards balance." Bullock also said that while inflation had slowed, unemployment had increased only slightly and remained low. "Our long-standing strategy has been to bring inflation back to target while preserving as many of the gains in the labour market as possible. This approach meant that interest rates in Australia did not rise as high as they did in some other economies, and so we may not need to lower them as much on the way down. We also know that Australians continue to feel cost of living pressures, with the average level of prices now notably higher than it was just a few years ago. That is why we want to make sure that inflation remains low and stable from here on in." Owen, now I should point out, Michelle Bullock didn't explicitly say the RBA had done a good job, but just reading between the lines, that appears to be the vibe from her speech. So the RBA thinks it's done a pretty good job. How do you assess the RBA's handling of monetary policy over the past 3 years?
Well, my vibe on the situation, Nick, is that yes, generally the general vibe of their performance is that they have done okay. It's no one will argue the fact that they could always do better, but it's probably one of the hardest jobs in the country, in the economy, to manage monetary policy. So it's because considering we're having a fairly soft landing on inflation, it's while other economies are looking at possibly having to increase rates, where we're still looking at decreasing rates again now. So it's quite been an interesting ride. It would have been helpful if the previous RBA management were a bit better, and we wouldn't have had as big a mess to try and fix in the last couple of years as we have.
There's only one thing the RBA can do to influence inflation and unemployment, and that's move the cash rate up and down. The federal government, of course, has a lot more tools at its disposal. So how would you assess the government's contribution to inflation and interest rates over the past 3 years?
Oh, it's they've probably made the RBA's job a lot harder, pumping more money into the economy, and really dumping the problem on the RBA to fix it. They don't have the guts to actually make effective change to fiscal policy by reforming the tax system and making any real effective long-term changes to our tax system. So it's really something that is quite uninspiring. And really, if this keeps on going, it's, I mean, let's face it, their main economic tool that they use was immigration to keep the economy in the positive, and growing. But in the meantime, each and every individual was going backwards. So yeah, quite disappointing, really, to sum it up.
There's something interesting Michelle Bullock said in that speech that you might have picked up on. She mentioned that just as interest rates didn't rise as high in Australia as in other countries, they might not fall as low. Right now, the cash rate is at 3.85%. Owen, where do you think the cash rate will be once the RBA finishes this rate cutting cycle?
Yes, well, we would probably be looking at the low threes. It would only be if we get into real trouble that they would have to drop it any further. And that's where they do seem to have managed it better than other countries, where we can have this softer landing. So, yeah.
Yeah, I guess if we have 3 more cuts, that takes us down to 3.1%.
Yep.
Does that feel about right to you?
Yeah, that feels about right for where we are, and it may only be 2 more cuts. And so it really comes down to how the economy reacts for the remainder of the year, and what else happens on a global point of view. There was a lot of doom and gloom about all of the Trump tariffs happening, and but it seems like that's going to have a milder effect than everyone was talking about. They've just announced overnight, Trump has announced a deal with the EU of 15% tariffs, I believe. So that really, it isn't that bad in the big scheme of things compared to what, was being talked about. And so, the sooner we can get on with daily life and daily business, without these distractions on a global scale, the more the markets can sort of settle down, and then the general public, individuals, can just maybe relax a bit and try and get on with managing their own lives without worrying about cost of living pressures and rising interest rates, etc.
Well, for our third story, we're going to shift from the RBA to ASIC, regulated to review debt management and credit repair sector. ASIC will launch a review into the debt management and credit repair sector as part of its continued focus on protecting consumers, particularly those experiencing financial hardship. Debt management firms help consumers negotiate with creditors, while credit repair agencies help consumers remove unfair negative listings from their credit files. ASIC surveillance will review how the sector, comprising about 100 licensees, complies with the law and the different business models they use. The regulator will review instances in which debt management firms may have failed consumers by not meeting the terms of their debt management agreement, charged high fees for no or limited services, or not communicated adequately with clients. Owen, what are your thoughts? Do you think there's a role for debt management businesses and credit repair businesses?
Oh, absolutely. I think it's a vital service. Whether people get into trouble for no fault of their own, most of the time people have financial hardship due to three main reasons. Divorce, um, injury, and sickness or injury, as well as health reasons, and then they lose their job for some reason, and so they don't have that income for a period of time, and so people get into trouble financially, and it's I think for there's like it's something like two-thirds of people are in to even three-quarters maybe of people at some point in their lives will have to um, go into some kind of debt management agreement, or worse, due to financial difficulty. So I think it's a service that has to be there, and to help people in need.
I think that's very well said. Some critics of these types of businesses, debt management and credit repair businesses, say, well, it's a rip-off because consumers can just do it themselves. But that's the case with pretty much every business. I could get my own home loan, but I'd much rather go to a broker. They're going to do a much better job. I can buy my own investment property, but the reason I use a buyer's agent is they're going to do a much better job. I can do my own taxes, but I use an accountant because they're going to do a much better job. And yes, people might be able to manage this themselves, but I definitely think there's a role for ethical professionals running debt management and credit repair businesses because they're going to do a better job than the average consumer.
Yes, and these people are in these situations for a reason because they haven't been able to manage it themselves, and if they need help because they're not in either a physical or mental state to be able to manage it, then it's only the problem will only get worse for them. So I don't see any reason why these services shouldn't exist for those that need it.
Okay, so we're in fierce agreement here that there's definitely a role for these kinds of businesses. So what do you think of ASIC's decision to investigate the debt management and credit repair sectors?
It's always good to have these investigations to make sure that because there's always sharks who take advantage of people in times of vulnerability, and certainly people who are in financial distress, are people who would be considered to be in a vulnerable situation. So yes, there needs to be some ethical standards set and met to be licensed in this industry. And so I think it's a good thing that ASIC is investigating to make sure that these standards that are set are what are expected of the community, and also to make sure that they are being met by the licensees.
Mortgage brokers, as we know, have been on the receiving end of an increasing amount of regulation over the past 2 decades, which has definitely cleaned up the industry, but which may have gone too far. Do you think there's a danger that ASIC may over-regulate the debt management and credit repair industries?
It's always a risk. government agencies, red tape. They have fees for the sake of having fees, and then they have penalties for not paying those fees on time, which are fees for the sake of having fees. So it's I'm not a big fan of ASIC in general. It's but they're a necessary requirement, and so we take the good with the bad.
Well, this has been a really, really good chat. We've covered quite a bit of ground in today's podcast, a few different topics. Thank you for your time, Owen. Really enjoyed it.
My pleasure, Nick, and you're always the best man to bring us the news each week. It's good to have a chat about it. So thank you again, and we'll see you next week. And if anyone wants to reach out to Nick, Nick, I haven't given you this opportunity for a while. I'm not sure. How is the best way for people to get in contact with you?
Two different ways. People can either look me up on LinkedIn, Nick Bendel. I'm very active on LinkedIn. The other option is to email me directly, nick@hunterandscribe.com.
Fantastic. Thank you for that, Nick. And yes, we'll see you again next week.